So, our friend Jamie here has opened a brokerage account and she wants to start investing in the stock market. She starts to go through the listings available for purchase, but she starts to get overwhelmed. Which one to buy? Which one is going to produce the best return? Which one pays dividends? Are they at all-time highs? Will the market crash? What will happen to my money? She's overwhelmed with these questions and decides not to invest. Sound familiar? There are so many options out there to invest in, it's hard to decide which stock or stocks would best fit us. Thankfully, there are also options out there that track a bunch of stocks, so you don't have to worry about picking stocks. These are called index funds, and try to alleviate some of the pressure from your shoulders. But the question remains, which one should I go with? Stocks or index funds? Let's explore it together. What is a stock? Since Jamie is new to stocks, let's give her a crash course on what stocks are. A stock represents a share of ownership in a single company. It's essentially a bet you place on the future of the company. You believe that the stock will rise in price, and so you buy the share at a lower price, hoping there will be a reward of some kind for you, either in the form of capital gains or dividends. The great thing about shares is that since you are a part owner of the company, you can vote on how the company is run. Pretty cool, eh? The downside to owning shares of a company is the risk of bankruptcy. If the company loses money and goes under, you are out all the money you invested in. There is no reward for your investment. It's gone. While some companies, such as large banks and conglomerates, are unlikely to go under, no company is completely safe from this risk. What is an index fund? Jamie is starting to understand what a stock is, but she also wants to know what an index fund is. An index fund is a basket of investments that track a particular market index, such as the S&P 500. Instead of owning shares of one company, you own a piece of multiple companies. Think of it as buying groceries. When you go to the market, shares of a single company would be akin to you buying 4 cartons of eggs and nothing else. Shares of an index is like buying 1 carton of eggs and then buying a bag of apples, a steak, and potatoes. It's more diversified. Let's use another example using pizza. Say you wanted to buy a pizza for dinner, but there are so many options. A share of a single company is like you ordering 1 pepperoni pizza. An index fund is buying 1 slice of 8 different pizzas, allowing you to have diversification in your pizza. Now, these are just 2 different ways that Jamie can invest in the stock market. There are plenty of other methods as well, including mutual funds and ETFs, both of which are like index funds. If you're wanting to learn more about different investment options, I have an ebook on Gumroad on how to invest for beginners. I'll be sure to leave a link down below in the description for you to go check it out. Main differences. Well, Jamie understands what a stock and an index fund are, but she's a little fuzzy with the differences between the two. I mean, after all, index funds are also partaking in company ownership. Let's help her understand the main differences between stocks and index funds. Diversification. Single stocks are considered higher risk. As mentioned before, if the company you are invested in goes under, you lose your entire investment. There is nothing coming back to you in the form of a return. Index funds tend to be lower risk. Since there is so much diversification within an index fund, if a company goes under, you won't necessarily lose your investment. There are other companies that can pick up the slack and keep your investment from going down. Now, that doesn't eliminate the possibility of that company dragging others down with it, but you aren't at the mercy of just one stock when you're invested in 99 others. Management. Single stocks require active research. Let's be honest, picking stocks can be tough work. That's why fund managers get paid so much to manage funds. They have the hard part of analyzing a group of stocks against each other and determine which one has the highest potential for growth and sustainability. Now, imagine if you were doing all that work. You could lose countless hours of productivity and sleep trying to build your perfect portfolio. Let's not forget to mention that once you have your stocks picked, you will have to manage them yourself by adjusting their positions if they get too lopsided in your portfolio allocation. Finally, having to buy individual stocks can potentially cost you a fair amount of commission charges, especially if you're making a lot of trades. Index funds are far different from single stocks. Instead of having to research different stocks and finding out which ones to buy, the index fund simply tracks all the stocks in said index. It makes it a more hands-off approach. Along with this more passive investing style, there are fewer trades being made, therefore fewer fees eating into your return. Returns. People may pick individual stocks that they think can earn higher returns than the market, which most of the time isn't the case. In some sense, picking individual stocks that individually outperform an index can result in higher returns. Picking individual stocks also increases the risk of exposure to bankruptcy and losses, among other things. While individual stocks may not grow in the same way as index funds, they can potentially provide more flexibility with dividend frequency, but that's a topic for another video. If you want to know more about dividend investing, I have a video about that. I'll be sure to put a notification on the corner of the screen, as well as a link in the description. Index funds aim to match the market return by mimicking the index. Tracking an index does reduce risk that would otherwise be present with individual stocks, but it can also result in lower returns. That said, the lower possible returns would be more stable and more suitable for long-term investing. Who should invest in what? As Jamie can see, there are some substantial differences between picking stocks and simply buying into an index fund. However, she's still a little bit unsure of which way to go. If you're in the same boat, allow me to make a couple of recommendations. Disclaimer: this is not advice on what you ought to do, rather than something to consider before making your decision. If you are unsure on what to do, speak to a licensed financial planner. They will help guide you on what path you need to take. For single stock investing, this is something that seasoned investors would want to investigate. They have the time and energy to research different sectors and industries and will dedicate the time to finding the best stocks to purchase. These investors are also comfortable with taking on added risk within their investments and will look to maximize their returns in capital gains, dividends, options, and other methods of return. They believe in their knowledge and abilities to make the right choices when picking stocks and are knowledgeable in the financial terminologies and lingo that comes with finances. These investors are also open to doing more short-term trading, such as day trading and swing trading with their positions. Index fund investing is more for those that don't have a lot of knowledge in finances, stocks, industries, and different sectors of the economy. These investors also don't have a lot of time to be researching different stocks and trying to determine which stocks will grow the most, pay the most dividends, etc. These investors also aren't comfortable with the added risk of individual stocks and want to rest easy knowing that their funds aren't exposed to as much risk as individual stocks would be. These investors are also looking for more long-term growth and won't be making as many trades as, say, a stock investor would. In the case of Jamie, I'd recommend exploring more of the index fund route. As to which one to pick, well, that is something she'll have to discuss with a licensed professional. They'll help her determine her risk tolerance and help her decide which is the most appropriate for her. As for you, if you're still hung up on what to do, maybe one of my other videos talking about how stocks won't make you rich quickly might help you decide. Thanks for watching, and I'll see you in the next one.